What really happens to the state of the economy. Moody's has cut India's growth estimate to 0.2% for calendar year 2020 from the earlier 2.5%. So let's try and understand what exactly was the rationale behind this. Fang, the Associate MD Sovereign at Moody's, joins us on the show right now. Hi, morning. Thanks for taking the time out. What explains this massive cut in your growth guidance for India?
Well, we've cut our growth forecasts for 2020 across the board for all G20 countries. I think for the developed economies, we're now looking at a 5.8% contraction. And for emerging markets in the G20, excluding China, we're looking at a 3.5% contraction. So it's really a across-the-board refresh in terms of the baseline. And what we're seeing now is that, in fact, the recovery from the impact of COVID-19 may be slower than what we had previously estimated in the second half of this year.
We're yet to hear on what happens to the lockdown in India. May 3rd is the last day of the lockdown. If indeed it were to be extended, would you then go back and rework your growth forecast for India? Or do you think at 0.2% for calendar year 2020, it somewhere assumes a lockdown extension?
To some extent, it assumes a lockdown extension, and it also incorporates our view that there are still a lot of risks to the downside, not just for India, but globally. We think that there are additional risks in terms of new outbreaks that could happen after lockdowns are lifted. And we do think that in addition to the health risks involved, there are broader risks to the economy, to all economies, including India's, such as those coming from financial stress and from much weaker consumer behavior. The impact on producers is also quite severe already in what we've seen from the lockdown, and all of that may act to dampen the rate of recovery, both in India and for other large economies.
What is it that you think would be the spending pattern from the government? Because while we've seen some measures trickle in from the central bank as well, but at large, we haven't yet heard a big economic stimulus coming in from the government so far.
I think that reflects to some extent the fiscal constraints that India is operating under. We are expecting some additional stimulus measures to come out. But at the same time, with the much weaker growth rates that we're projecting, we do recognize that there's going to be a negative impact on government revenues, and that's going to limit the ability of India to apply more fiscal stimulus in this very challenging situation.
Sure. Are you bound to then change India's sovereign rating as well, and not just India specific, but would that be applicable to all G20 nations, much as you are cutting down your growth forecast as well?
I think we're currently monitoring all the G20 countries very closely. What we're seeing, as you can see from our report, is the fact that the growth shock, the economic shock, is common across much of the world. And in addition to that, we're seeing a very substantial fiscal response in much of the world as well. So we're not going to single out any particular country, because what we want to keep on doing is keep our ratings. We want our ratings to reflect an ordinal ranking of risk. And so from that perspective, there's a common shock facing many economies around the world. And what we want to see is how the response coming out of this shock may indicate a change either upward or down in terms of the sovereign risk. So it's really about what kind of response reaction we assess India to come out with, and that's going to be a key driver when we look at the rating.
Sure. Within the G20 pool, though, Jean, which countries do you think are worse off than the others? And where do you see bigger growth contraction as opposed to the others?
Well, I guess to some extent, if you just look at the contractions, I mean, as a whole, developed markets are seeing a larger contraction than emerging markets. But in many respects, we do think that the risks might be higher for emerging markets. I think some of the issues I talked about earlier involve the risk of new outbreaks, the risk of increased financial stress, and the risk of seriously impacted consumer and producer behavior. You might see these as bigger risks for emerging market economies, just given the fact that factors like health infrastructure tend to be less developed, and that might lead to more outbreaks. Social safety nets are also generally less developed as well, and that might mean that the effect of fiscal stimulus is somehow limited by the ability to reach large parts of the population. So although we are projecting a bigger contraction in terms of the flat-out number for developed markets, in many respects, the risks of a slower recovery might be higher for the emerging markets.
Sure. Besides a stimulus from the government for the economy, Jean, what are the other parameters that you would look out for on ground as economic indicators of a revival or a bit of a turnaround of things?
Well, I mean, I think the fundamental indicators will be, business activity on the ground and the ability for many of the businesses that we're monitoring in India and even more broadly the business landscape to show some signs of renewed activity and recovery, as well as recovery in terms of consumer sentiment and consumer activity. So I think those are the key factors that we're watching for. And in many respects, as I mentioned earlier, I think there's a very substantial impact that we're seeing on the real economy. What governments around the world can do is to try and to mitigate those negative effects, but it's really the ability for the real economy to get started again, which is going to be the basis for any sustained recovery.
Yeah, absolutely, Jean. Good to have you on the show, and we'll hopefully chat once we hear an economic stimulus package announced from the government. Good to speak with you.
Thank you.